It's often believed that the Federal Reserve has never really been able to hike interest rates without leading to an economic downturn. At a first glance of this chart of the US central bank interest rate and all the recessions since 1955, it seems like this is an inevitable reality. When the Federal Reserve raises interest rates, it's inevitably followed by recessions. And so it's not a surprise that many have been considering the possibility of a recession happening this time around after one of the fastest increases in interest rates we've seen in history. Some say a recession is absolutely inevitable within the next year, and some say that if it didn't already happen, then we're not going to get a recession at all. And that's not completely absurd, because there have been moments in history when the Federal Reserve has raised interest rates and that wasn't followed by a recession. These were moments when the economy slowed down but never actually entered a recession. This is what's known as a soft landing. So we're going to look at what the actual historical odds are that the Fed can raise interest rates without triggering a recession, and we're actually going to come up with a specific percentage likelihood after I show you all of the evidence. In total, we can count 13 episodes where the Federal Reserve has raised interest rates in what are known as tightening cycles. Out of the 13 cycles of rising interest rates, it seems 10 of these were officially followed by recessions, also known as hard landings. So there seems to only be 3 exceptions to the rule: the 3rd, the 8th, and the 10th tightening cycles. So that already gives us a 77% chance, based on history, that we also see a recession this time around. But it may not be that simple of a calculation, because in 2020, for example, the pandemic may have been what really triggered the recession. It's unfair to assume that the very slow and gradual tightening that the Federal Reserve did between 2015 and 2019 would have led to a recession without the COVID lockdowns. The US economy was growing quite well in the 4th quarter of 2019. Real GDP growth, a measure of economic growth in the US, actually seemed to be trending higher at that moment, printing a GDP growth rate of 3.2% for the 4th quarter of 2019, which is pretty good. It wasn't until the first half of 2020 that the economy made a 180 turn during the COVID lockdowns and entered a recession. That looks very different to what happened in 2008 and 2001, where we had gradual declines of GDP heading into those recessions, not a sudden shock. So for the sake of being fair to the Federal Reserve, let's say that that recession would have not happened without the pandemic, and that it could have been a soft landing just like the other 3 episodes. In fact, the same thing can be said about the 1989 tightening cycle. The Federal Reserve stopped raising interest rates in March of 1989, but it wasn't until August of 1990 that the US actually experienced a recession, over a year and a half after the Federal Reserve actually began to lower interest rates. In August of 1990, Saddam Hussein invaded Kuwait, a major oil producer for the world. This immediately caused oil prices to more than double overnight, from $17 a barrel to $40 a barrel. Higher oil prices means the cost of producing goods goes up, the cost of transporting them goes up, the price of gas at the pump goes up, which makes people cut their spending. So when oil prices rise like they did in 1990, it immediately puts downwards pressure on the economy. So was it the fact that the Federal Reserve raised interest rates in 1989, or was it the Kuwait oil shock that triggered the recession? When we look at GDP growth in 1990, it went from growing steadily at a healthy 2.4% in the first and second quarter of 1990 to declining violently in the second half of 1990, right when the oil shock happened, plunging the economy into a recession. So although we'll never know for sure whether a recession would have happened without the invasion of Kuwait, we can also give this episode the benefit of the doubt, which would mean that 5 out of the 13 episodes where the Federal Reserve raised interest rates were or could have been soft landings, which only leaves a 61% chance of a recession occurring after the Federal Reserve raises interest rates. We can already understand a lot better why economists are torn between the hard landing and the soft landing prediction. But when we look at these 5 episodes in a little bit more detail, we see that all 5 of them happened to occur at a moment when inflation was quite low and stable. At most, inflation reached 4%, which means that the Federal Reserve didn't really need to be aggressive when they were raising interest rates. You see, the Federal Reserve has a dual mandate. They want stable prices, but also maximum employment. That means when prices are not stable, or when inflation is hot, the Fed needs to raise interest rates aggressively to bring inflation back down. That's what happened in the 1970s when inflation was very hot, and they triggered recessions very frequently in order to fight it. But when inflation is low and stable, it means the Federal Reserve doesn't need to worry too much about stable prices. Instead, they can focus on everyone reaching maximum employment, which is exactly what happened in these 4 episodes. In these 4 episodes, the Federal Reserve never raised rates to the point where monetary policy was what they call restrictive. Restrictive is a term that they've used many times in 2023 to describe the Fed's current monetary policy. The easiest way to visualize what restrictive means is by looking at this chart. All of the moments where this chart is above this line are when monetary policy was restrictive. In these instances, the central bank raised their interest rate above long-term interest rates. And when they do this, it creates restrictive conditions for the economy. Now, they usually don't do that for very long, but when they do it, it means there's an underlying problem in the economy. For example, the Fed made monetary policy restrictive back in March of 2000 in order to pop the speculative technology bubble in the stock market at the time. Technology stocks were in a speculative euphoria in 1999, and when the Fed made conditions restrictive in March of 2000, the very top of the bubble was actually in March of 2000. In February of 2006, the Fed also made monetary policy restrictive to stop the speculative behavior they were seeing in the housing market. The housing bubble that had been developing was popped that very same year. In the 1970s and 80s, they made monetary policy restrictive in order to cool inflation down, something that they've also done today. Going back to the 1950s, there's only 9 times when the Fed raised rates to the point where monetary policy actually became restrictive like it is today. So there are 4 episodes of rising interest rates that never actually reached a restrictive stance like today. So again, to be fair, we need to remove these episodes from our study, leaving us with these 9 episodes, 3 of them that were soft landings or could have been soft landings, and 6 of them undeniably led to recessions or hard landings. Now, that doesn't actually change much in terms of the odds, but it does bring us to a 66% chance of seeing a recession this time around based on history. But this wouldn't be completely fair, because for example, we're counting 2001 as a hard landing when this was actually an incredibly mild economic downturn that could actually be counted as a soft landing depending on what we're looking at. Real GDP, for example, in 2001 actually never went into negative territory when we look at the year-over-year change. The economy continued to grow year by year, and despite that, the NBER, the organization that labels recessions, labeled 2001 as a recession. Because when we look at the unemployment rate in 2001, we did see it rise throughout that period. The problem is that a lot of these job losses actually came from the technology bubble that was bursting. This is a chart of the number of jobs in the information and technology jobs in the United States, and it reached exorbitant levels in 1999. But once the tech bubble blew up, a huge number of people lost their jobs in that industry, which contributed to the high levels of unemployment in 2001. Had it not been for the technology bubble, perhaps we never would have seen a recession in 2001. And the same thing can be said about 2008. If we didn't have a housing bubble in 2006, maybe the 2008 recession and financial crisis wouldn't have occurred. That's the problem when it comes to macro. Each episode has its own context. It's impossible to predict with certainty whether we're going to see another economic crisis like 2008. Today, with the term soft landing trending at its highest level on Google and the stock market trending at all-time highs, it's safe to say that many people don't believe that anything is going to break in the system. So although the odds based on this study suggest there is a 66% chance of seeing a hard landing, as you can see, it depends on an immense number of different factors. We have many ongoing recessionary bets right now with our clients, but we're also exposed to more aggressive bets like Ethereum that's up 30% since we initially posted that investment idea. Real macro investing is about finding great risk-reward investments, not necessarily being able to predict the future with certainty.